Hello, it's Anthony Mento. Here recording. I appreciate you joining. The reason we're recording is we had some audio difficulty on March 11th. This was such a topical presentation that we've had several requests to get this out into distribution. So, the topic is to use emerging legislation to spark life insurance sales. And this is quite the political football. So there's so much to cover that we've actually decided to make this a three-part series. One is planning in a low interest rate environment, and I'm going to take you through just a quick State of the Union, and then go through a case study that explains four ways to acquire life insurance in a trust, particularly in today's low interest rate environment. Part two of the series will be income tax and stock market volatility. We're going to bring in a tax specialist on this one, and I think you'll have a lot of fun. And then third, what a lot of the webinars don't do in the industry is really get into product. For you product gurus, this is going to be a fun one. I think you're going to really appreciate session 3, and it'll fit into the solutions that fit the concepts and strategies we talk about in parts 1 and 2. So I'm going to dive in. Just a quick State of the Union, and there's so much buzz in the industry. I am an active member in FinSeca. I'm an ambassador to Senator Jeff Van Drew in New Jersey. So we keep tabs on what's happening in Washington and certainly how it would impact our industry. We faced some regulatory changes that hit in 2020. First and foremost, we went through a 2017 mortality table update. We went through a product repricing due to principle-based reserving. There was a huge influx of business at the end of 2020. Reserve requirements have gotten a little bit more stringent. Combine that with a low interest rate environment, further exacerbated by COVID, and we've seen several pricing reprice products over the last 8 months. And then of late, revised section 7702, which we're starting to see some movement on from a carrier standpoint. So headwinds the industry has faced, just quick recap. COVID, and more COVID, right? We enter March, April, May of 2020, and I can't even get an examiner into someone's home, nor would anyone allow an examiner to come into their home. Just a quick story. We had a affluent client in New York City. Examiner arrives at the door. Client says, "Ma'am, I appreciate the effort in you getting here. May I ask what method of transportation you used?" She said, "I took the subway." And he said, "I'm sorry, ma'am, I can't let you in my home." So, kudos to the carriers who stepped up to the plate and allowed us to continue to conduct business without the need for fluids or an in-person exam or a face-to-face meeting to physically sign with ink an application to do business. We face continued low interest rates, puts tremendous pressure on the insurance companies when you have to capitalize X amount in reserves to pay future claims and you're not earning anything on those assets in tier 1 risk-free investments. Then it creates tremendous pressure for shareholders and profitability. Carrier instability and abandonment. I gave kudos to the carriers who stepped up at COVID. Shame on the ones who didn't. There were many carriers who put their tail between their legs and did an about face and said, "Hands up. If you're over age 70, I'm not touching you. You have asthma, I'm not touching you. You have diabetes, I'm not touching you. Sorry." That was a little bit of a disruption for us. Continue product repricing, more complex products. So carriers are getting cute when there are ways to work around AG 49 and work around some of these reserving issues. And we really need to unpack, how the sausage is made before we can go make a recommendation to our agents, who then make a recommendation to their clients. We've seen countless bogus premium finance designs, everything from free insurance to interest roll up to bank payoffs with magical income streams in retirement. And from a transactional and operational standpoint, carriers had to literally mobilize a workforce of tens of thousands of employees to a work from home environment. So some of the headwinds that we faced. Now President Biden ran on a platform of some very aggressive tax policy, which are now coming to the forefront as an aid to assist in paying for the most recent stimulus of $1.9 trillion. So let me dive in and give you some of the proposed Biden initiatives. So tax increases over 400,000 of income. In short, as I teach my kids their math and their reading, I always like to give them some type of analogy to relate to. In this particular instance, think of the 4 and 4. 400,000 of income, 4 million of net worth, looking to raise 4 trillion of revenue. So 4, 4, and 4. Earners over 400,000 of income, there is talk to expand the Social Security tax above the current 142,800. I don't think this one gets through. March Madness is approaching us. I would look at this as a 7 or 8 seed, winning the getting to the Final Four. It's a toss up at a 50-50. Restoring a 39% marginal rate, that's like a 1 seed getting to the Final Four. I mean, this one's very likely. Capping itemized deductions to 28%. So what this means is if you're in a 39% bracket, you're not getting 39 cents of relief on your tax return. It's going to be capped at 28 cents. And that's as simplistic as what I can explain. Restore the P's limitation, which in English is more caps on itemized deductions for high earners. There's likely going to be a new Section 199A deduction phase out. I don't think the left side liked this one to begin with, and that one will probably come to fruition. Taxes on capital gains. This is again going to make some of our products that we sell a little bit more attractive. The talks of 39% rate applied to capital gains over $1 million. This is a target. Earners at 400,000 is a target, but earners at 1 million have a bullseye on their back. We're talking about elimination of the step up in basis at death, which could count for quite literally $1 trillion of revenue to the IRS, where we're realizing gains at death. If I look at calculating the top marginal rate, when you're taking all these things into consideration, it appears as though there could be 4 very relevant states that have income tax brackets approaching or north of 60% if you combine that with a SALT cap. Senator Schumer is making a huge push to lift that SALT cap, so that remains to be seen. But what we're giving you here is combined top rate without SALT cap and with SALT cap. So here we go again. The products we sell, if positioned properly, are life insurance products. Long-term benefits are tax favored. So if you're looking at long-term dollars, this could be a heck of a bucket to accumulate some wealth and set yourself up for a future income stream. When you're looking at the estate taxes, the Tax Cuts and Jobs Act essentially doubled the basic exclusion and the GST exemption in 2018. It took us from, call it 5 million to 10 million. We adjust for inflation. In today's dollars, it's $11.7 million. In 2026, we ask our agents, do your clients intend to live for another 5 years? The answer is yes, of course they do. Well, if the current law stays in existence and the Biden initiative never gets through, which we feel to be highly unlikely, then the $10 million exemption tapped with inflation is going to revert back to $2011 and call it $5 million of exemption. With inflation, you're looking at about $6 million. So our current exemption amount at 11.7 likely to will by law reduce to 6.1, which is a very significant reduction in the neighborhood of 40%. So we fast forward and we look at the platform that President Biden ran on, and he intends to restore 2009 estate tax levels at a $3.5 million exemption and a 45% rate. This is likely a 2 or 3 seed getting to the Final Four. This one's got some meat on the bone. You've probably read about Senator Warren's wealth tax, and although at times there was a time where we thought that was mostly ridiculous, is now getting some attention because some of the components to it have some merit and may actually stick around in whatever bill is going to be proposed to Congress. So what we've been doing for our agents who then in turn share with their client is utilizing the Lineberg software. We're entering a current net worth with the assumed growth rate, adjusting the annual exclusion by an inflation rate, and we show today's tax exposure. On a $30 million estate, husband and wife, combined exemption of $23 million. If simultaneous death occurred today, the tax would only represent 8.8% of their gross estate. Call it a $2.6 million tax on a $30 million net worth. This is a Texas resident, so we're not so much concerned with state estate tax. But if you're in a state that does have state estate tax, that certainly should be considered. Should these clients who are both age 75 live through 2026, which they all both plan on doing, the $30 million net worth would grow to 33, and that tax would expand from 2.6 million to 8.3 just because the current law sunsets and reverts to 2017 levels. Represents 25% of the gross estate being lost to taxes. Should they live through 2036, which is their statistical life expectancy, the estate would then be worth $40 million, and a $2.6 million tax today turns into 10.7 in 2036, which represents 26% of their overall assets. Fast forward and make some projections that the Biden initiative passes, and the estimated impact on a $2.6 million federal tax liability today immediately turns into $10.6 million federal estate tax liability in the event the Biden initiative passes. That represents 35% of their overall net worth. And in 2026, that Biden initiative still in effect, $33 million net worth represents $11.9 million of federal state taxes. So this deserves attention. It deserves your clients to sit with their advisor and talk, strategize what we do in the event that something like this would be put into law. Now, I'm going to remind you some of the tax laws that pertains to life insurance. There are 5 internal revenue tax codes that really put the power of life insurance to work. Section 101A allows death benefit to be passed along income tax free to the beneficiary. If I structure ownership in a trust, maybe add some spousal access and some dynasty languages, then you're really looking at an income and estate tax-free asset through the use of gifts, which is an extremely powerful story in a rising tax rate environment. Section 7702, this one's caught a bunch of attention. It defines the use of life insurance for tax-deferred growth. Wall Street Journal articles we've had the pleasure of providing commentary on will expand the limits for what we can put into a life insurance policy and still receive the most favorable tax treatment without violating MEC. IRC Section 72, that allows for tax-free policy withdrawals to basis from a non-MEC policy. So here we are setting up some income. Folks in the potential 60% income tax bracket states, you're looking at Section 72 very closely. And then we have Section 101G, which in a nursing home crisis in the midst of a global pandemic becomes extremely valuable. 101G defines how a life insurance death benefit may be accelerated tax-free in the event of a chronic or terminal illness to maintain your independence and stay in the home versus going into a nursing facility. So that was a quick State of the Union. Now we'd like to talk about how change brings opportunity. And oddly enough, for the first time in my career, I am finding that the supply is as good, if not greater than the demand. I'm sorry, let me rewind that. The demand is as good, if not greater than the supply. And let me tell you let me explain what that means. Supply is the product that the insurance carriers are manufacturing. Products are being pulled off the shelves, particularly long duration products. The demand is extremely high for the purchase of life insurance with those long-term guaranteed contractual elements. So what we're finding is that as these pricing changes occur or carriers announce they are leaving a product line, we're finding a rush to application, submission, approval, placement. It has been quite a year thus far where we're finding major carriers like Principal, Prudential, Lincoln retool their product lines and install price increases to coincide and maintain profitability with these extraordinarily low interest rates, as we say, further exacerbated by COVID. So as I look and turn this into a three-part session, the focus today is going to be gift planning in a low interest rate environment. We'll get to session 2 and we'll get to session 3, but for today's purposes, we're going to dive in and we're going to look at a case study using gift planning in a low interest rate environment. Allow me to dive in. Okay, so it's case study. It starts like any other case study. In October of 2020, P&C agent calls in, we'll call him Agent C, and he says, I get a good one. These clients are wealthy and I want to see a bunch of illustrations and I think we should finance the premium. And, it tends to be the default strategy in the industry that, a big case equals premium finance without doing any fact finding or understanding a client's risk tolerance or what their assets look like. And the case study I'm about to share with you here takes you from start to finish, where we identify the issues, utilize the resources, and then implement one of the 4 choices, in my opinion, that we have today to acquire life insurance outside of the taxable estate in one of 4 ways. So Agent C says, I want to see a single life on John. He's the husband. Let's look at a one pay, a life pay. Let's look at UL, but he's also got a whole life that he bought years ago. I think we should show whole life as well. So that's 1, 2, 3, 4 illustrations. Then I think we should do the same thing on Joyce because it may be beneficial to buy on her. She's female, she's the same age, so pricing may be better. Let's look at a single pay, a life pay, a UL, and because John owns whole life, let's look at some whole life on her. And then, while we're at it, we might as well run a survivorship. We're going to do a single pay, a life pay, a UL. You see where I'm going with this, right? So we have quite literally 12 iterations. I'll check, 5 whole life carriers. We'll check a dozen UL carriers. So we are literally running hundreds of illustrations without knowing a single thing about the client. So this was only the beginning, but it was our chance to impress Agent C and show him our quoting capabilities and pull all of these illustrations into a one-page chart rather than litter his inbox with several hundred pages of illustrations for him to figure out. What we suggested was to really engage with the tools available. And these aren't just life brokerage tools. These are tools that can be used, you can purchase directly or you can use with any BGA. But for the purpose of sharing and educating today, I'm getting right to it. And I'm going to suggest that this client had 2 businesses. He had no idea what they were worth. We engaged with Principal. They have a wonderful unit called the Bose unit. If you're not working with them, you should be. And we obtained business valuation on both of those companies. We also did a buy-sell review. We found out that we had 2 grown children who were active, well, somewhat active in the business, but receiving above fair market value compensation. From an estate planning software, we gathered, now we had the appraisal, we had the other personal assets, and we had the ability to create a financial statement, which we could then take and arrive at that $30 million number, which you saw in our prior analysis, use the Lineberg number cruncher or Insmark Wealthy and Wise, and look at the estate tax exposure under certain circumstances and different conditions, whether it be current law or whether it be the Biden initiative. death today, death in 2026, death at life expectancy. You now understand the exposure. And we bring in the original OGs on the professional underwriting side. Our boys, Chris Lyons and Kenny Tursack and Will Walker. You do a preliminary app. Let us purchase the records, and before we start running, quite literally 100 illustrations, let's let our underwriters read the file and see what we're working with. And if I can uncover some fact findings, we have two businesses. One's worth 12 million, one's worth 15. Again, I have two adult children being paid way more than they probably deserved. All the cash and income were coming from these two businesses. The estate tax software and modeling identified a significant need. And if I match that with the financial statement that I was able to collect, I uncover that the personal assets don't even meet the premium commitment that we're asking the client to spend in those 100 iterations of life insurance illustrations. So very clearly in this particular instance, business will need to be the source of premium. This isn't a lesson on how to sell. What I'm sharing with you is that because we were able to uncover data and facts, we were able to identify the source of premium. If you can't find the source of premium, you'll never sell a large case because it will be a pain point. In particular, this particular agency was looking for the client to use personal assets to meet an enormous premium commitment that they just couldn't do. Lo and behold, after we purchased all the medical records and our professional OG underwriting team got a chance to peruse, we find that John has active prostate cancer. So all the single life illustrations we ran was complete waste of time. And the survivorship pricing was quite honestly complete waste of time. What we did identify was that we should focus on Joyce. She is a preferred risk at a female age 75, assuming a normal exam. And now we're moving ahead and the case is back on track, right? Here we go. Here are our options. Joyce does well on her exam. We have a preferred risk. We can shop to a number of companies, but we've dialed in on 3 particular carrier and product solutions. And as we sit down with the design team, we realize in today's environment, there are 4 ways to acquire life insurance in a trust. You can gift, and we talked about time running out on these gifts. You can make a private loan or an intrafamily loan to acquire life insurance. You can sell an asset, or what I like to call rent an asset, through the use of an installment sale. Or you can go to an external third party and finance the premiums, typically through a commercial bank or a margin account, right? So if you really think about it, there are 4 ways to acquire life insurance, particularly in today's low interest rate environment. So right here, we've identified gifting. The source of the gift would be a K-1 distribution from one of the S corporations that was loaded with cash and has already paid tax on the money. So very simply, K-1 distribution out to John and Joyce. You make a subsequent gift to a trust. And what we're showing you here is that you make a gift of $322,000 and you can acquire $10 million of single life, although we've listed both here to make John feel important. This is a single life policy on Joyce, female, $10 million. And what we're showing here is the internal rate of return on that gift, opposed to not making gifts, retaining the $322,000 in the gross taxable estate, growing at 5% pre-tax, 3.15% after tax, and then getting clobbered with the federal state tax, assuming current law. Under the Biden initiative, this becomes a very different story, right? And we've looked at what our exposure was. And this is a method of in which Life Brokerage presents in our agent's colors and logo, and we'll simplify this in a 1-page solution. we would recommend a SLAP provision in the event that the policy had cash value, like the contract I just showed you. Do a nice job describing, what the SLAP provision looks like. And, the attorneys that we work with have all signaled to us that they have not done as many SLAP provision trusts in 2021 as they have ever done before in the first 3 months of a calendar year. Secondly, knowing these companies are cash rich, we could make a split dollar loan under Section 7872 from the company to the family trust, right? So this is option number 2 to acquire life insurance in a tax favored manner, owned by an irrevocable trust. So what we're showing you here is the imputed interest for the split dollar, and that's on a present value basis. The software does a nice present value calculation, which I'll show you on a subsequent slide. But here's your loan to the trust for the premium. Here's your policy cash values. The death benefit of $10 million will be used to pay back the family business, whom the children will inherit eventually. So it's getting right back to the same pocket, right? For all intent purposes. The downside of this play is that the longer the insured lives, the less we're going to net to the trust. However, the more loans that are advanced, the more loan repayment the corporation will receive. So, we may overcome this with a return of premium feature, but these particular clients, we're not really interested in the split dollar arrangement. It will work for some. It didn't work for this particular client. What I'm showing you here is how our software calculates the imputed loan interest on a present value basis, so that we can utilize the gifting capability we have in 2021 before the tax law changes. Next option and opportunity is to sell, or what I like to call is rent, a piece of one of these businesses, right? And what we've started with is 17.75 million of business assets. And if we did nothing, this is our way of illustrating in columns 1, 2, and 3. We show 4% appreciation, estimated federal tax due on the asset, and what you'll net to the family. So that gives you a reference point on, if you did nothing. Now, we have a family business. There are multiple partners. Advisors felt comfortable with taking a 30% discount for lack of control and marketability. So on a 17.75 million of business asset, we can sell that to our trust for 12,425,000. That's very simply 70% of 17.75 million. And the terms are, it's going to be a nine-year deal, interest only payments. At the end of the 9th year, the trust needs to pay back the grantor in full, or in cash, or in kind. So in kind means taking the shares back. So in this particular instance, the midterm AFR is 62 basis points. So 62 basis points on the sale price of 12,425,000 yields an interest payment back to the grantor of $77,000. So that's obligation number 1 of the trust. Pay the grantor back at least the interest that is due at a low interest rate environment of 62 basis points. So I have 77,000 of liability, quote unquote, per year. If my asset earns 4%, which it's earning somewhere in the neighborhood of 9, I would generate, or the trust would generate, $710,000 of cash flow. Now, remember, we owe the grantor back $77,000. So that leaves us with $632,000 of positive cash flow within the trust. So I go out and magically, that exact number, $632,965, we reversed engineered to go out and be able to afford $10 million of life insurance on a 9-pay premium structure. So that At the end of the 9th year, the policy is paid in full, guaranteed to age 85, projected at 4.45% crediting. And at that time, in the event that the business is liquidated, we can then repay the grantor in cash. Or if the business is not liquidated, you may repay the grantor in kind. So the business or the grantor will take back the business interest. All the appreciation was frozen inside of the trust, and we've captured that outside of the gross estate. And we have a $10 million paid up life insurance policy. So the result of the transfer at age 90 of both insureds gives you a net positive of $7.1 million. So here is the effect of leveraging insurability on female 75, the cash flow against the installment sale interest rate of 0.62 due to being in the extraordinarily low interest rate environment, and the asset being able to generate a positive cash flow to arbitrage that interest rate, that interest payment back to the grantor of $77,000. Really cool technique. Some will debate, do you if you get a discount on the way in, do you get a discount on the way out? That's a matter of opinion, and we would typically leave that up to the tax or accounting professionals involved in the case. Either way, is a $7 million positive arbitrage. Fourth option that we talked about, and I'm approaching my limit on time, would be going externally to a commercial bank or a wirehouse on a margin call and go out and finance the premium, right? There was plenty of liquidity inside the S corps that we can post as collateral that's sitting in a cash position. Go out and borrow the $322,000 that, call it 2.5%. We can gift the loan interest. We could present value the loan interest gifts if you'd like, just like we looked at on the split dollar side. And again, great tool, but the longer, if you're betting to live, the longer you live, the more you erode the net trust death benefit, and the more that has to get paid back to the bank. This strategy was dismissed immediately. Client was not interested in interest rate risk or eroding the net dollars to the trust. Again, I would consider, if there was underwriting and financial capacity, adding an option C, return of premium, death benefit rider, so we can level out at $1 million. It'll cost a little bit more, but typically that works out in our favor. So the moral of the story today is that change brings opportunity, and we will keep you abreast of any changes in Washington. We will tie them into opportunities that are presented to us in our industry, particularly capitalizing on a low interest rate environment and taking advantage of the clock that's ticking to gift significant amounts of wealth before a change in tax law. Next up in series part 2, we're going to dive into the income tax issues that are coming down the pike, how life insurance can overcome some of those income tax issues and challenges, and take a deeper dive into stock market volatility and how you can position yourself using life insurance products to hedge against a volatile stock market. So I thank you for your time. Appreciate you dialing in. Feel free to use this in segments, listen to different parts at different times, not just all in one sitting. And if anyone would like any follow-up material, we'd be more than happy to share these one-pagers and a copy of the slides. And again, I thank you for your time and appreciate your business. Stay well.